Hi, this is Mark with your analysis for the week commencing the 19th of May 2013. Before we go into this week's analysis, I want to go back and cover last week's and explain what happened and why it's important you watch the video as well as just reading the notes. This is the British pound, and I went into great detail last week. I explained that we were at a crucial point on the British pound. I explained in the notes as well, but in the video I showed you in far greater detail. And what I explained clearly was we were looking at a potential break of a trend line. And I showed you that 153.30 was a major line in the sand, along with a 50% fib and with EMAs just above. So what happened? Well, price came down on the Monday, closed clearly below the area, and the very next candle came back, touched it to the pip, and fell hundreds of pips from a move that I had shown you was a possibility a week ago. And yet I got emails from people, and I have private clients who I was talking with who were looking for pullbacks up here and said, well, why did he pick this? It is important that you watch the videos. Now, let's have a look on a daily chart. On a daily, very simplistic chart. Now, I showed you during the week on Wednesday's update why I initially longed this pair at the market open. And the reason was, when you look on a 4-hour chart, you can see how price after the open had simply gone sideways for 3 or 4 candles, and I longed here. And because I moved the stop to entry quickly, I managed to avoid a loser. But the reason I took this trade potentially as a long initially was because of this channel that we are in. It has been highly significant since the middle of March. And the good thing about this potential trade was that you only needed a small stop and you had a potential reward of hundreds of pips. So I explained in Wednesday's write-up, it didn't matter to me if this trade lost, because if this trade lost, then the flip side of this was that this move was highly significant, and I explained that there was nothing below this to stop a potential big drop. So a low risk potential high reward trade here, had it lost, would not have bothered me, because I then had the opportunity of a low risk high reward short. The bottom line is this was an easy, predictable, low risk potential high reward trade, and you really should have not missed this opportunity. Having said that, it's always easy when you look back at things, but I had flagged this up in advance, and therefore it's frustrating for me when people say, oh, well, I didn't see that line. The line I have had in place, this one for weeks and weeks, as well as this trend line. Equally, on the subject of flexibility in last week's video, I showed you how I had been in a trade here and got taken out by this nasty spike, and then price had dropped hundreds of pips. I explained that I would ideally prefer a pullback to this area because it had been major previous support and resistance. And I then explained that, however, if we got a break and close below 100 parity, and I explained why it was a very bad idea to long here, because parity is an area that people all over the world are watching. You've got this falling knife scenario, lots of dollar strength all around, very, very risky to long here. But what I explained was if we had a clear break and close below 100, and we got it on Monday, 99.50, I then explained that I would then be looking for a pullback to 100. And what did it do? Took the pip, it bounced back off this area, and then promptly fell another 200-300 pips. Again, this was a predictable move that I had explained to you in advance. Now, this then comes to the point of what do you do as a trader? I know I spoke to a few people who were looking for pullbacks with Pierre's method all the way up here, or possibly with my method down here. This is where it comes in that you need to decide what kind of trader you are. If you are simply trading one system and the setup doesn't come along that week and you can mentally and financially cope with walking away, then that's fine. That's the rules that you played by, and therefore, well done, walk away. However, you have to bear in mind other things, and parity is hugely significant. Parity overrides almost everything else on a technical basis when parity breaks. And this is on a daily chart, so this is a major move. This is not that it's broken through for a few hours and then whipped back up again. This has been a major substantial break of a hugely significant area that traders all over the world are watching. And therefore this was logical that once it had broken, price would come back to test it and then fell away. So this one move from analysis done the week before yielded almost 300 pips. The week before that, I showed you on the CAD. I've been explaining for 2 or 3 months now how I was waiting for price to come back down, and I explained all the reasons why I chose 10020 as an area to long the CAD. And if you're not sure about this, go back to the previous week's video. So what happened? Traders all over the world are looking at parity. And look at this, back in 2012, every time it came up and hit it and slammed into it and spiked through it, it turned back down again. Why? Because everybody all over the world is looking at it. When you're looking at fibs, it's subjective. Some people might have their fibs down here. Some people may have fibbed the other way around. But when it's parity, everybody is aware of it. Therefore, this one move from the previous week is currently 250 pips in profit. So that's 250 odd pips from the Aussie dollar, 250 odd pips from the US dollar CAD from weekly moves. That's a month's profit. Thank you very much. Walk away. The important thing is you must learn to be flexible. And again, I showed you on the euro pound, I said to you, imagine that you were like a bank trader and you were only able to trade one pair a week. You would then go into far greater detail, you would have lots of different chart setups, and you would be scrutinizing and learning about the nuances of this pair, and you would also be looking at lots of potential trades. And what did I say to you? Well, I'd shown you the week before how we were looking for a pullback here, that we got a winning trade the week before. Then last week I said, whilst price was down here, if price pulls back up to these EMAs and 8,500, I will look to short again. The week before I explained why I'd gone at 85.20 for a stop. So all of that had been explained. And what did price do? Well, it came, it spiked through. Had you taken this from a daily, you would have got filled down here and you wouldn't have had to go in at 8,500. Very next candle comes up, touches 8,500 to the pip, and that fell away 60 or 70 pips. As you know by now, I double my risk on the euro pound because the average daily range is much smaller, and therefore a 50 pip gain on this is the same as 100 pips on any other pair. Other things of note from last week, I explained on the Friday night after the market closed how price had closed just below the all-important 130 area, and how again you've had a break and a close, and therefore a pullback to there was logical. Now I explained I didn't take the euro last week. It's been far too messy recently. Lots of nasty spikes up here, which usually mean that you get taken out and then the damn thing goes in the direction that you were wanting. But that was a perfect example. Spinning top, the dollar Swissy had set off in the other direction. There was all-round dollar strength. You could have waited for this candle for your pullback with your stop above the EMAs and the half number of 30.50, which had held the week before, and therefore that was a logical area. The reason I didn't like it was because of the fact that 129.00 wasn't so far below. There were loads of stages on the way down with this one that I didn't fancy. Final ones then, the yens. I showed you on the dollar yen how I was looking for a pullback for 100. Not a pair I trade that often. Still only interested to long at that point, and I showed you on Wednesday if you were following this up, then all you would do is you would move your your support and resistance lines up and then look for pullbacks. The concern here, of course, is that this monthly 200 EMA was just above where price was likely to stop, and it stopped to the pip there on Friday. The dollar yen, I was explaining how my ideal entry would be down here 99.80, 100 area. Unfortunately, this didn't do it until Friday, and therefore I had cancelled the trade, as I do not trade on a Friday. Murphy's Law, it bounced back up and went 40 odd pips into profit before closing at 30 odd pips in profit. I certainly wouldn't have left this open over the weekend, because if there was any major negative news against the yens, we could see a gap, and I don't want to be in a trade with only a 30 odd pip gap stop rather at the market open. This was with just candlesticks and Bollingers on. At one point last week, this was even more helpful in terms of a potential entry because we had a never in a million years Bollinger Band coming up steeply behind. You had the 55 EMA just below as well. So it was an interesting setup, but not one that I took. Murphy's Law once again. This was the Euro Yen. I explained last week that my preferred pullback was much lower down, but you could be looking for bounces off the monthly 200. We had a break and a close above, and therefore it was a logical area, and it worked 2 or 3 times, and I didn't take any of them because I don't really like this pair. But sod's law, it happened. MoveOn.com. Let's look at next week's analysis.